Hi and welcome. I'm Adam Jones, Senior Advisor at Keeler Management. Today we're going to talk about 401k plans, more specifically why you should be participating in your company's 401k plan and how to know what to look for so that you can take advantage of it. Let's give you a little history or background about 401k plans. So they really started in the late 70s. The Internal Revenue Code added section 401k. That's where the name comes from, is from this Internal Revenue Code. And what it allowed people to do was to defer their income for tax purposes. It really wasn't adopted at first until about 1981, a few years later, when it really caught fire and took off. And so many companies started adopting these new 401k plans. And they really are a phenomenal tool for both an employer and employee to use. So before they introduced the 401k plan, there was what's called pension plans or defined benefit plans. What was defined was the amount you would get in retirement. So you'd work for a company for several years, you retire, and then they'd give you a pension or a paycheck for the rest of your life. While that was a good deal, it was very burdensome and hard to control and manage, and the responsibility was on the employer to make sure that the funds were available for those people. And as people started living longer and lifestyle changes, that became a problem. So they introduced the 401k plan, which shifted a lot of the responsibility onto the employee. They're now responsible for putting enough money away and investing it to create some lump sum that they would have to which they could fund their retirement. So we're going to talk about how the 401ks work, how to contribute, all the different rules and things you need to be aware of. First of all, when you yourself are making a contribution to a 401k plan, you have the ability to choose when the money gets taxed. So for the longest time, there was just one option, and it's what's called a pre-tax contribution or a traditional contribution, where you put money into the plan before it gets taxed. It comes right out of your paycheck, doesn't get taxed, goes into the 401k plan, and it grows tax deferred. So when we get to retirement and start pulling the money out, that's when we pay the taxes on it. The advantage of doing that is you get to reduce your taxable income dollar for dollar for the amount you put in the 401k plan. So let's say you put in $10,000, you just get to reduce your taxable income by $10,000. So $10,000 goes to the 401k. When I go to my taxes, I get to reduce what is taxed to me. That can be a real tax tool for you. Now, we're not tax advisors, so make sure you talk to your tax professional about what's your best option. Then in about 2006, they introduced what's called the Roth contribution, which is the opposite of the pre-tax contribution, which is we're using after-tax dollars to go into the 401k plan, and it grows tax-free. When we pull money out, we don't have to pay taxes on it. That's the obvious advantage of the Roth contribution. And generally speaking, for someone who's younger, they've got a long time to work, the Roth option is a good option. It's also a good option for married couples or people making lots of money. It really depends on your situation, on what type of contribution you should be making. And you want to talk to your HR representative or your administrator of the 401k plan to understand if you have both those options and what you're currently doing if you don't know, so you can adjust if you need to. In the year 2023, if you're under the age of 50, you have the opportunity to put away $22,500 of your own money. If you're over the age of 50, they have something called a catch-up provision. Catch-up goes good on everything, but that's not what we're talking about. We're talking about being able to catch up, put more into the plan. So if you're over 50, you can do an additional $7,500 for a total of $30,000 that you can put of your own money into a 401k plan. Okay, so this is a really good tool. Now you and a spouse are both working and able to put those amounts away, you can really make an impact on your retirement savings. All right, so we've talked about how you make contributions to the plan, and just as a reminder, that comes from your paycheck. You can't take money from outside sources to fund your 401k plan. It gets reduced from your paycheck and goes in. It's a great way to save, probably the best way to save money. Otherwise, people wouldn't do it. Just take it out of my paycheck before I can have access to it. Okay. So we talked about how you make contributions. Let's talk about how the employer makes contributions. And there's a few different ways that they can do it. One of the first ways is something called a safe harbor contribution. So the employer says we want to give a benefit to our employees. We'll put money in there for them. And if we promise to make it what's called fully vested, meaning if we put our money in as the employer in, it's always their money immediately. So if they left work, they could take those contributions with them. In doing so, they have the ability to put away money as the business owner or a highly compensated employee can participate in the plan at a greater degree as long as they're helping everyone out. The second way they can make contributions is something called a match, where if you put in 5% as the employee, us as the employer will match that and also put in 5%. Now, I don't know about you, but I love free money, and that is free money. So if your plan offers a match, you're going to want to make sure that you're putting in at least that much. So if my company matches 5%, I should be doing at least 5%. I should have a goal of saving as much as I can, but that's the bare minimum. That's the bare bones, because that's free money, 100% return on your money. Absolutely should be doing that. Now, that money that the employer is putting in on a match basis may be subject to something called a vesting schedule, where before, the money you put in is always yours. That always happens in every 401k plan. In a safe harbor match, that money is always yours also. But in this matching calculation that we're talking about, where you put in 5%, the company puts in 5%, whatever the company puts in may be subject to this vesting schedule. It's usually something called a cliff or a graded scale. A cliff meaning after 3 years, all that money becomes yours, no matter how long you stay there, once you've hit that 3-year mark. And the second option is the grading scale, which you get a certain percentage each year. It's usually a 6-year thing. After 1 year, it's 0, 2 years is 20, then 40, 60, 80, then 100%. So you want to make sure you understand how your plan works. That can affect how long you might stay at a company or what company you choose to go work for. The other way a company might make a contribution to your account is something called a profit-sharing contribution. So the company says, hey, we had a great year, we have extra profits, we want to share those with the employees, and we're going to do that through the 401k plan and add more to their balance and put in a contribution. That is also subject to those vesting schedules. Okay, so the money you put in, always yours. There's certain limits on how much you can do. On top of that, the employer puts in money, and it's, between the two, there's a limit on how much can go in. For 2023, if you're over 50, it's $73,500 from all sources that can go into the 401k plan. So you want to be aware of that if that affects your situation. And again, the reason employers are offering these types of plans are to attract good employees, retain good employees, and provide them with a nice benefit. So if you have that benefit at your work, you should be taking advantage of it, because there's either free money there for you or an opportunity for you to really save and prepare for retirement. One of the decisions that has to be made when you're participating in a 401k plan is, how will my money be invested? You have the option in your 401k plan to choose how the money gets allocated in different mutual fund-based investments, so that your money can grow. And this has the effect of compounding interest. So not only the first year the interest we earn goes into the account, the interest we then earn after that goes on top of that, and it builds much larger. This creates wealth in the long run. So investing is an important part of the 401k plan process, and understanding how you should invest your dollars is very important. Far too often people don't ask enough questions or don't understand how it works. We really encourage you to talk to your HR or your representatives or your financial professional to understand how you should invest your 401k dollars. There's a few things to consider when you're talking about investments or the decisions you make about investments. The first is your risk tolerance. How comfortable am I with taking on risk? Do I want to be really aggressive? Do I want to be middle of the road? Do I want to be really conservative? Am I okay with fluctuations in the balance? So there's tools out there to help you identify where you might fit on that risk tolerance scale. And then oftentimes your 401k plan will offer risk-based investment options, meaning if I want to be aggressive, I can choose an aggressive portfolio to match my risk tolerance. Or if I'm totally nervous, or I want to be real conservative, I want to preserve what I put in there, I can be more conservative. So there's lots of options. What you don't want to do is pick something when you first start your job and then never look at it again. You should be reviewing it to make sure it's meeting your needs and it's reacting to what's happening in the current market and economy so that you can take full advantage of doing that. The 401k plan is only part of the puzzle of retirement planning. Okay, so what's important is understanding what matters to you, what you want your lifestyle to look like down the road, and how you get to that point. They used to run these commercials several years ago called "What's Your Number?" And the idea behind it was, how much do I need to achieve financial independence? And for some people that means retiring or achieving some goal so that I can live the kind of lifestyle that I want. And we encourage everyone to start that process. And you have to put pen to paper, do some calculations to determine how much I'm going to need in the future so I know how much to start saving today. Just as an example, let's say someone is 25 years old. They're participating in a 401k plan and they're saving $500 a month or $250 per paycheck if they're paid twice a month. That's $6,000 a year. If they do that for 40 years, and they're earning an assumed rate of interest of 7%, they would end up with over $1.3 million in their 401k account. And we haven't said anything about what the employer might be putting in on top of that. So you can really start to impact your number by using the 401k plan as part of the overall retirement planning process. So start there, figure out how much you should be contributing. One thing I want to say is if you fit into this camp, we really encourage there's a change. I see a lot of people who are spending absurd amounts on their monthly car payment, so much more that it's way more than they're contributing to their 401k plan. So you should have a goal of always contributing more than what you're paying for your car. Because when you pay a lot for your car, you're robbing your future happiness by getting a little bit of happiness now to ride around in a little bit nicer car. So there's your tip for today, is make a goal of putting more into your 401k plan, budgeting so you can understand how to do it, and how it will impact your future financial self. Let's review some of the things that we talked about. We talked about how much you can contribute, $22,500. If you're over 50, it's an additional $7,500. That's $30,000. Your employer is most likely making a contribution, whether it's a safe harbor contribution, a match, or a profit sharing contribution. You need to understand how those work. Make sure that you're doing at least the minimum to get the free money that your employer is offering you. You should have a goal of getting to be able to max out your 401k if you can, and then start considering other investment vehicles. And when choosing your investments, make sure you're choosing something that is in concert with your risk tolerance. It's helping you achieve your goals, and you know what your number is, and you're working towards that. We're going to be talking a lot about other financial topics, so stay tuned. We're happy you could join us today. Have a great day.